Since stocks and shares began to be traded, markets have fluctuated, sometimes wildly, as confidence and panic swell, then crash prices. The reason for this, of course, is that even traders are often irrational and emotional. But increasingly, stock trades are being handled not by people, but by machines, and it's a trend that looks set to grow.
Once, trading floors looked like this, but in the 1980s, computers swept most of the old bear pits away. Today, a sizable bulk of trading is carried out by desk-bound brokers. Even this could soon change as more trading becomes entirely computer-controlled.
We go back to the floor trading days where you had lots of individuals on the floor reacting to market movements. Now it's almost like the movie Terminator. You've got a lot of machines in a room and they're making trading decisions.
One example is HFT, or high-frequency trading. In itself not that new, but huge leaps forward in technology, coupled with market deregulation, have made this form of automated trading massive.
High-frequency trading has at one level been around for a long time. It's just the frequency and the size of it has increased dramatically, and that's an advent of the way technology has advanced.
Technology that runs increasingly complex mathematical programs, which automatically search markets worldwide for minute changes in share prices and carry out transactions at an unbelievable rate.
When we are talking about high-frequency traders, we are talking milliseconds.
You've got systems like Chi-X where you're actually seeing, on average, 600 microseconds.
That's fast, far faster than humans could even process the price information. As a result, the sheer number of trades has rocketed. In the US, only 2% of financial companies are high-frequency traders, but they account for nearly 75% of equity trading volume. And by dealing in bulk at speed, HFT companies can make money where sluggish, old-school traders can't.
Shares that traditionally were market made either on the telephone or were made on the floors of exchanges in the 80s and early 90s. Spreads tended to be a lot wider. High-frequency trading firms tend to make markets inside those spreads, and they can do it a much smaller size and actually tighten the distance between which you can buy and sell shares at.
However, to do this takes some serious computing power, and that takes space. But data centres can be based practically anywhere. Nearly an hour's drive from the financial district of London, in a dreary satellite town, is LD5, the heart of trading firm Equinix's financial operations. For obvious reasons, we can't show you the exact location, as they take security very seriously indeed. But once past the bulletproof glass, man-trap, airlock and biometric scanners, you can, under escort, have access to 16,000 square metres of technical space.
When coming to Slough, we were able to find a very large facility, but also with access to power, which is critical to the growth of electronic trading, but also with close proximity to major telecommunications routes to allow people to connect both to other exchanges and other places around the world.
Which is vital, because no matter how fast you trade, someone will be competing to trade even faster. By co-locating near major telecommunications hubs, milliseconds more can be shaved off transaction times. And even this may not be enough.
At the velocity that many of our customers are trading, with many trades per second, being able to reduce that latency improves their performance and improves their chances of being successful traders. And so, whereas before people worked very hard to shorten the distance by being in the same city, now it's literally about being in the same room and having the speed of light work to their advantage.
That's why some companies have set up multilateral trading facilities, or MTFs, like Turquoise, Chi-X and BATS Europe. They've introduced new technology allowing greater interaction between high-frequency traders, creating almost a one-stop shop.
Previously, a trader would have to go to multiple exchanges across Europe if they wanted to trade a pan-European basket of securities. What the MTFs have offered is the ability to trade pan-European securities in one place.
However, this brave new world is not without its problems. In May this year, the Dow Jones plummeted nearly 1,000 points in a matter of minutes in a flash crash that some argue was caused by volatility following HFT firms pulling out of the market. Others believe it was simply a very human reaction.
What we've seen recently is that some of these HFT might just plain simply pull out of the market. and that can cause an issue. Because all of a sudden that liquidity pool that was there has disappeared and significant volatility ensues.
I think that one of the biggest problems was there was a lack of certainty about whether a trade that had been executed in the market was going to stand or not.
What is certain is that regulation is high on the agenda across the entire financial industry. And as a relatively new and rapidly evolving area, HFT is sure to come under the spotlight.
There is a high-frequency witch hunt, as I call it, out there at the moment, whether it's the regulators pandering to political sentiment.
I personally believe there's enough regulation in the equity markets as there is. There's a MiFID II review going on, which is looking at post-trade data consolidation, and a few other areas where I think we can advance and tighten the regulation from the MiFID. But in terms of high-frequency trading, they're a natural force. You know, they really, we think, add positively to the market, don't exacerbate volatility, and really, you know, are not there to be regulated out.
HFTs are generally good for the market liquidity. What they are doing is that essentially they are bringing that sort of efficient market theory into a reality.
However it's regulated, high-frequency trading is here to stay, and as technology continues to develop, will no doubt become faster and even more efficient.
There's been comments out there about, are we going too fast? Should we slow systems down in some way? Actually, that overturns Moore's law, which means every few years the price of technology halves and the capacity doubles. And really, if we look at the technological advancement and just human advancement, that flies in the face of that. And if we took that approach of just slowing technology down, I think we'd all be living in caves again.
The level of sophistication of algo trading and high-frequency trading is going to continue to increase. There's at one level almost an infinite number of possibilities, and that's what makes the markets and makes them very, very interesting.
And could even make the vilified banker a thing of the past as well.
And Algo Technologies are working on a new platform that can carry out trades in just over 100th of a second, which they claim is 20 times faster than any current system.